Chapter 4 Analysis of Financial Statements 1. Introduction. Business and non-business enterprise undertakes financial transactions. These financial transactions are recorded as per rules and principles of accounting. These financial transactions pass through different stages of accounting. The commencement of these stages is from journal entry. At the end of these stages, final accounts are prepared. The component of final accounts are trading account, profit and loss account, which is also known as income statement and balance sheet. These three are financial statements. Besides, cash flow funds are included in financial statements. These financial statements disclose the results of financial transactions of particular period of time. This kind of information can be ascertained from them. Financial statements represent historical information. These financial statements represent results of financial transactions of accounting period. In brief, profit and loss account discloses result of business enterprise and balance sheet disclose financial status of the business. Cash flow statement related discussion is undertaken in subsequent chapter. Cash flow statement also discloses the result of difference between cash inflow and cash outflow of financial activities of the business. Trading account. In debit side, particulars, amount. In credit side, particulars, amount. To opening stock 10,000, to purchase 50,000, to gross profit 40,000, total 1 lakh. By sales 80,000, by closing stock 20,000, total 1 lakh. Here, gross profit is the result of purchase and sales transactions. Trading account discloses information about result of Rs 40,000. These transactions can be represented in the following form. The information presented in this form can be interpreted. The process of interpretation and analysis is given below. Particulars. Sales 80,000 less cost of goods sold, opening stock 10,000 plus purchase 50,000, total 60,000, minus closing stock 20,000, 40,000, gross profit 40,000. Here, 1. There is a profit of Rs 40,000 because goods of Rs 40,000 are sold for Rs 80,000. Rs 40,000 is result. But the factors of this result creation are sales, closing stock, purchase and opening stock. Even a small change in one factor leads to the change in result. Example, in above mentioned problem, if the value of closing stock is Rs 24,000 instead of Rs 20,000, the cost of goods sold will be Rs 36,000 instead of Rs 40,000. Consequently, gross profit will be Rs 44,000 instead of Rs 40,000. So through analysis, the information pertaining to affecting factors is uncertainable. 2. The creation of gross profit is from sales. Therefore, the proportion of gross profit to sale 40,000 gross profit divided by 80,000 sales into 100 is equal to 50%. Gross profit has relation with sales. The gross profit increases due to the increase in sales if other factors remain constant. Hence, quantum of gross profit would increase. In case of above mentioned illustration, if sales is Rs 1 lakh and there is no change in other factors, that is, cost of goods sold remains Rs 40,000, this will give gross profit Rs 60,000. So, there is direct effect of change in sales on gross profit. This kind of information can be availed through analysis. How the gross profit of Rs 40,000 is earned? What is the proportion of gross profit to sales? This is uncertain through the interpretation of information disclosed in financial statements or by presenting the results in a different manner. This process of interpretation is known as an analysis. Thus, the interpretation of the information or result given in financial statements is known as analysis. Analysis of financial statements. Which tools are used? Which procedure is used for analysis? To whom is it useful? What are its objectives? 2. Meaning of financial statements. business or non-business entities maintain their accounts. For preparation of these accounts, rules, principles, traditions, and assumptions of accounting are considered. Financial statements are those statements which provide the results of different financial aspects of the entity. Financial statements are organized reports which disclose detailed financial condition of the business entity. 3. Objectives and types of financial statements. Objectives. Different financial statements are prepared under the accounting system. Every financial statement has its own independent existence and use. Financial statements like income statement, balance sheet, and cash flow statements are prepared. 1. To know the profit or loss of the business entity. Business entity undertakes revenue activities throughout the year. These activities are of two types, receipt and payment. If receipts are more than payments, difference is known as profit. If payments are more than receipts, difference it is known as loss. The information for such profit or loss is available from the prescribed financial statement. This statement is called as income statement. Therefore, the first objective of the financial statement is to ascertain the profit or loss of the business. 2. To know the financial position of the business entity. The financial position of the business entity is determined on the basis of difference of assets and liabilities. When the values of assets are more than liabilities, it is called as good financial position. When the value of assets is less than liabilities, it is called as weak financial position. This information is available from the prescribed statement, which is known as balance sheet. The second objective of preparation of financial statements is to know financial position. To know the cash position of the business entity. The business undertakes transactions of cash receipt and payment during the year. The information about different sources of cash and application of cash is available from the prescribed statement. This statement is known as cash flow statement. The third objective of preparing the financial statement is to know cash inflow and outflow of the business. In brief, serial number, financial statement, objective. 1. Income statement, profit and loss account. To know the profit or loss of any specific period of the business entity, this statement is prepared. 2. Balance sheet. To know the financial position on a specific day of the business, this statement is prepared. 3. Cash flow statement. To know the cash inflow and outflow of any specific period of the business entity, this statement is prepared. 4. Significance of financial statements. The information disclosed in the financial statements is useful to the existing and potential stakeholders. The financial statements are prepared to satisfy the different types of requirements of management, existing and potentially investors, fund providers, short-term creditors, employees, customers, governments, and other different agencies. The financial statements are important for these stakeholders, but the analysis of financial statements accelerates the significance of these statements. 5. Meaning of financial analysis. The objectives of preparing the financial statements are predetermined. Financial statements represent information and results. But after preparation of financial statements, they are rearranged in such a way that they become comparable. The different stakeholders take their decision the basis of financial statements which are prepared in a comparable form. This entire process is known as analysis. 6. Types of financial analysis. Financial analysis is done for internal and external purpose. This can be done in the horizontal form, vertical form, for short term and for long term. Discussion pertaining to this is as follows. We can present different types of financial analysis. 1. On the basis of stakeholders. 1. External analysis. 2. Internal analysis. 2. Horizontal and vertical form. 1. Horizontal analysis. 2. Vertical analysis. 3. On the basis of duration. 1. Long-term analysis. 2. Short-term analysis. 1. On the basis of stakeholders. Financial of a business entity are used by various stakeholders. These stakeholders can be categorized into two categories. 1. External party. 2. Internal party. 1. External analysis. When published, like income statement, balance sheet, report of an auditor or directors are analyzed by external parties like potential investors, financial institutions, government agencies, credit rating agencies, researchers, etc. for their investment related decision or for any other decision. It is known as external analysis. 2. Internal analysis. The management of the business take their decision from accounts prepared by them. The base of these decisions is analysis. When financial statements are analyzed by the decision is known as internal analysis. The information available for this kind of analysis is accurate and elaborate. 2. Horizontal or vertical form. This kind of analysis can be done in two ways. 1. In the horizontal form and 2. In the vertical form. 1. Horizontal analysis. Financial statements are prepared every year. The comparison of financial statements of different years is known as horizontal analysis. This analysis is done for long-term planning. This analysis is useful to know the current trend. This analysis is known as time series analysis. 2. Vertical analysis. This kind of analysis is used to compare financial statements of 1 year. This analysis is used to compare the performance of different units or departments of 1 year with the help of different predetermined ratios. Financial statements of different units for the year 2017. Statement of income, balance sheet, statement of cash flow. Company X. Statement of income, balance sheet, statement of cash flow. Company Y. Statement of income, balance sheet, statement of cash flow. Company Z. The comparative analysis for 1 year among different units of different financial statements can be called as vertical analysis. 3. On the basis of duration. One significant concept of accounting is going concern. As per this concept, the existence of business entity is permanent. While preparing the accounts, the concept of periodicity is also considered. It is generally of 12 months. 1. Long-term analysis. Many stakeholders like debenture holders, financial institutions, and potential investors undertake long-term analysis of financial statements before investing their funds in the corporate form of business. For this analysis, information of more than 1 year is needed. Under this analysis, these stakeholders determine the present and future long-term solvency, profitability, liquidity, and efficiency of the borrowers. In brief, under long-term analysis, the evaluation of above-mentioned dimensions is done with the help of financial statements of more than 1 year. 2. Short-term analysis. This kind of analysis is used to measure short-term solvency or liquidity of the business entity. This kind of analysis is done by the short-term lenders as well as the suppliers of raw materials. Objectives of financial analysis. Financial analysis has different objectives for different stakeholders. Important objectives of financial analysis are as follows. 1. Evaluation of earning capacity. Generally, financial statements are prepared for the duration of 12 months. What is the earning capacity of entity during this period? This analysis is made with the help of different accounting ratios. Besides this, the future earning capacity of the entity also can be forecasted. Mostly all stakeholders, for their investment decisions, gather information of present and future earning through analysis. 2. Efficiency evaluation. Business entity acquires different assets as per the nature of business. With the help of these assets, production and sales are done and services are provided. The use of these assets should be at maximum level. Maximum use of assets generate more earning. Through financial analysis, the evaluation of the efficient use of assets can be done. 3. Solvency evaluation. Solvency of the entity is categorized into two types, short-term solvency and long-term solvency. Different parties provide goods and services to business entities on credit. The payment of these goods and services is to be made in short-term period. Therefore, the providers of goods and services measure the short-term solvency of the business. Financial institutions and banks also provide long-term advances to the business entities. They undertake evaluation and forecast of long-term solvency of business entities. Through financial analysis, evaluation of short-term and long-term solvency of that business can be done. 4. Evaluation of managerial efficiency. The owners and the management are two different entities in the company form of business. Funds of shareholders are managed by the board of directors. Besides, officials execute the decisions taken by the board of directors. Therefore, through financial analysis, evaluation of effectiveness and fairness of the decisions of the board of directors can be done. The performance evaluation of the officers can also be done through this analysis. 5. Planning for budget. Budget means the quantitative planning or statistical planning of future objectives in present. What will be the future sales? How much purchase is required? How much will be the production? How much cash will be required? What will be the revenue expenses? What will be the capital expenses? Etc. is estimated. Analysis of financial statement is useful to make the process of budget effective. 6. Comparative study. Two types of comparisons can be done through financial analysis. In the first comparison, the business entity can compare its current accounts with the accounts of past. Different aspects of business entity like profitability, liquidity, solvency, and efficiency etc. of the current year can be compared with the previous years to know the growth of the above-mentioned aspects. In the second comparison, all these aspects of business entity are compared with the results of competitors. This is known as interfirm comparison. Whether business entity is strong or weak as compared to its competitors can be ascertained through financial statement analysis. 7. Simplicity to understand accounts. Financial accounts are prepared on the basis of determined rules, principles, and terminology. It is possible that all the users of financial accounts may not have full knowledge pertaining to financial accounts. Under these circumstances, financial analysis helps to understand the financial accounts. In financial analysis, the presentation of financial accounts is done in various ways. It provides simplicity to the users to understand financial accounts. Therefore, they can make therein and other. In brief, the financial analysis assists to understand the financial accounts. Due to the analysis of financial statements, different objectives can be achieved. These objectives explain the significance of the analysis of financial statements. 8. Uses of financial analysis. Generally, 4 different aspects are analyzed from the analysis of financial statements. 1. Analysis of profitability. This discloses the earning capacity of business entity. 2. Analysis of liquidity. This discloses the short-term solvency of business entity. 3. Analysis of solvency. This discloses the long-term solvency of business entity. 4. Analysis of efficiency. This explains the degree of use of assets. 1. For dividend decision. In the company form, dividend decision is analyzed by different stakeholders like existing investors, potential investors, and company itself. What amount of dividend can be paid is decided by the management of the company. What amount of dividend will be received is estimated by the investors. The dividend decision is determined through profitability analysis. The payment of dividend is based on earning capacity. This can be decided by profitability analysis. For dividend payment decision, financial analysis is useful. 2. For investment decision. Investors invest their funds in a company for 2 purposes. 1. To receive regular income of dividend or interest. 2. For capital appreciation. The information pertaining to both the purposes can be availed from profitability and solvency analysis respectively. Thus, investors use this analysis for their decisions. 3. For lending decision. Short-term and long-term loan and advances are provided to the business entities by banks and financial institutions to know how far their advances are safe. The analysis for examination of short-term and long-term solvency is useful. 4. For borrowing decision. This decision is useful to the business entity itself. From their analysis of financial statements, business entity can estimate its own borrowing capacity to borrow funds from the market. On the basis of this evaluation, the opportunities for new investment can be explored. 9. Uses of financial analysis. The information disclosed in the financial can be used directly by the stakeholders. But after having analysis of financial statements, the information of financial statements become more precise and understandable. Therefore, all the stakeholders can take their appropriate decisions. This analysis is used for internal purpose, for external users, for short-term decisions, for long-term decisions, for existing investors, for potential investors. 10. Limitations of analysis of financial statements. The analysis of financial statements is done in various ways. This is useful to different parties. Different stakeholders acquire appropriate information about good and weak aspects of business entity through this analysis. However, there are some limitations of financial statement analysis. 1. Historical data. Financial accounts are prepared on the basis of past transactions. Thus, financial accounts are known as historical accounts. The analysis of financial statements is based on historical information. From this analysis, the future can be forecasted. The shareholders and other parties are more concerned with the future of business entity, which cannot be availed from this analysis, but the estimation of future can be made. 2. Ignorance of inflation. Due to inflation, information disclosed in financial statement does not represent the real status. Specifically, at the time of the valuation of assets, the impact of inflation is ignored in financial statements. Assets are disclosed at their old value and replacement cost, which is higher, is not considered. Income is prepared at current prices and balance sheet discloses actual prices of past. Thus, one statement is prepared as per current price and other financial statement is prepared as per the historical price. In brief, the value of money is not considered comprehensively. Therefore, the result as per financial statement analysis might fail to provide guidance. 3. Absence of qualitative aspect. During financial statement analysis, only quantifiable items are considered, but factors like contribution of workers for development of business and loyalty of management towards business entity, honesty, expertise, etc. are not considered. All these factors have relation with efficiency of business, but these are ignored. This can also be considered as a limitation of financial statements analysis. 4. Based on presentation of financial statements. The operation of analysis is done on the basis of information provided in financial statements. The correct and fair analysis and interpretation are entirely based on information disclosed in the financial statement. There is a direct relation between true and fair information and effective and efficient analysis. Thus, if information of financial statements is incorrect or inadequate, the true and fair analysis of information cannot be done. Here, the financial analysis is a dependent variable which is based on appropriateness of financial statements. 5. Personal opinion. There are options in accounting for preparing the accounts. Example, use of depreciation method, inventory valuation method. Thus, there is a possibility of personal opinion. Due to these options, there is a room for subjectively in preparation of accounts. This also creates hurdle of financial analysis. Thus, it can be considered as a limitation. 6. Window dressing. As stated earlier, fair financial analysis is based on the truthfulness of the financial statements. Many times, the information disclosed in financial statements is not found be correct. Accounts are prepared on the basis of incorrect information rather than correct information. Thus, decisions made by the stakeholders stand incorrect. This is also a limitation of financial analysis. 7. Disclose only symptoms of problem. Financial analysis provides information of causes of the problems but does not provide the solution of it. For example, if company has expected 30% of gross profit and company earns 20% gross profit, the reduced gross profit rate can be seen through financial statement analysis. But why gross profit is reduced cannot be ascertained. The management has to find out the solution and has to frame strategy accordingly. The limitations of financial analysis are the result of limitations of financial statements. If the limitations of financial statements are eliminated, the limitations of financial analysis will be removed automatically. 11. Significance of comparative financial statements. Financial statements are prepared on the basis of the principles and rules of accounting and in the predetermined form so that the financial accounts represent results with consistent base. To understand accounts easily by the stakeholders, financials are presented in rearranged form. Due to this process, the utility of financial statements increases. 1. Intra-firm comparison. Every year financial statements are prepared by business enterprises. When the accounts of business entity of current year are compared with the accounts of previous years, it is known as intra-firm comparison. As compared to previous year, whether the efficiency is increased or not, profitability is increased or not, whether the solvency is increased or not can be analyzed. Besides, when one business entity has various departments, their financial performance evaluation is also done. This is also included in the category of intra-firm comparison. 2. Inter-firm comparison. An industry comprises of various business entities. When financial statements of various business entities are compared to the other business unit can be ascertained. This information is ascertained through inter-firm comparison. Different stakeholders may rethink on their investment decisions due to the inter-firm comparison. So to undertake the financial condition comparison between two units, financial statements analysis is useful. 3. Indicates trend. Due to comparison of financial statements of different years and different sections of business unit, the information of trade pertaining to financial position and profitability is ascertained. On the basis of this trend, different stakeholders undertake forecasting of their decisions. The trend of different aspects is disclosed by financial statements analysis. The trade helps to make decisions. 4. Useful to creditors. Creditors of business units are long-term and short-term. Creditors determine credit worthiness of business units through analysis of financial statements. So it is also useful to the creditors. 5. Simple and comparable presentation of information. The information disclosed in the financial statements is prepared on the basis of rules of accounting. But when information of the financial statements is rearranged, it becomes simple to understand and analyze the financial statements. Generally, the information of financial statements is rearranged in the form of table. Thus, it becomes useful and simple to understand. 12. Stages of analysis of financial statements. There are legal rules for the preparation of financial statements. Financial statements are prepared on the basis of rules. In the company form, financial accounts are prepared as per Companies Act 2013. There is a provision for structure and nature of financial statements. Different stages are developed for the analysis of financial statements. Due to these stages, an organized and scientific analysis can be done. These stages are as under. 1. New structural arrangement of financial statements. Different tools are used for the analysis of financial statements which are prepared as per the legal provisions. Where common size financial statements, ratio analysis etc. are included. The information disclosed in financial statements is reclassified and rearranged to undertake use of these tools. This arrangement makes use of tools more favorable. Example, to know the trend of net profit of last 5 years, the profit rate is used. Its formula is net profit divided by sales into 100. Table of net profit rate. Here, net profit, sales, net profit ratio in percentage. 1. 60,000, 5 lakh, 12%. 2. 77,000, 5 lakh 50,000, 14%. 3. 1 lakh 10,000, 8 lakh 50,000, 13%. 4. 80,000, 5 lakh, 16%. 5. 84,000, 5 lakh 60,000, 15%. Total 4 lakh 11,500, 29 lakh 60,000 divided by years 5 is equal to average 82,300, 5 lakh 92,000, 14%. 2. Comparison. In the second stage of financial analysis, reclassified and rearranged information is compared. The sales and net profit feature shown in above mentioned table are compared with sales and net profit of its previous year. That is, the comparison of the results of the second year with the first year. Profit, sales and net profit rate are increased as compared to the first year in the second year. In this way, the results of the second year with the third year, of the third year with the fourth year, and of the fourth year with the fifth can be compared. Analysis and interpretation is done on the basis of comparison. 3. Analysis and interpretation. Analysis means appropriate examination or evaluation of information when information is categorized into different components and the relationship is tested. Interpretation gives explanation of this relationship. Net profit and sales shown in the above table are the components of the financial statements, that is income statement. There are two variables for computation of net profit rate and both are interrelated. Theoretically, the increase in sales leads to the increase in net profit. It means the sales and the net profit has positive relationship. As compared to the first year sales is increased from Rs 5 lakh to Rs 5 lakh 50,000 in the second year, and the profit is also increased from Rs 60,000 to Rs 77,000. In the third year, sales are increased, profit is also increased. In the fourth year, sales is reduced and profit is also reduced. Again in the fifth year, sales are increased, profit is also increased. In practice, it is possible that in spite of having increase in sales, there may be reduction in profit, or despite the decrease in sales, the profit increases. This process is known as analysis. As compared to the first year, net profit rate of second year is increased from 12% to 14%. It is good for the company. But in the third year, sales is increased as compared to the second year. Profit is also increased, but rate of net profit is reduced, which is 13%. It can be said that profit earning capacity of the company is reduced during the third year as compared to the second year. From the information of 5 years, the total sales of 5 years is Rs 29,60,000 and profit is Rs 4,11,500. Their average respectively is Rs 5,92,000 and Rs 82,300. This is a kind of interpretation. In this way, the interpretation can be done each year. This process is known as interpretation. 13. Tools of analysis of financial statements. The preparation of financial statements is the last stage under the financial accounting. In this stage, the preparation of income statement and balance sheet are included. In the company form, cash flow statement is also prepared. In this, details of income, assets, liability are disclosed in the form of rupees, that is, in the form of currency of respective country. All these details are shown in the financial statements in legal form. Many a times, it is difficult for a common man to understand them. In order to resolve this problem and to make information of financial more understandable, the analysis of statement is done. For this analysis, information of more than 1 year is used. For this process, different tools are developed in accounting. An analysis process is done with the use of them, where common size financial statements, comparative statements, and ratio analysis are included. The explanation of comparative statements and common size statements is as follows. Comparison of financial statements. The financial information of at least 2 years is required for comparison process. The development details of predetermined period are obtained through comparison. It can be known that which period shows good result and which shows weak results. In comparative statements, the details of income statements and or balance sheets of 2 or more than 2 years are compared. Comparison of financial statements. Through comparative statement, profit and loss statement balance sheet. Through common size statements, profit and loss statement balance sheet. Comparison of financial statements can be done by two ways. 1. Through comparative statements. Under these comparative statements, comparative balance sheet and comparative profit and loss statement, that is income statement, are prepared. This comparison is done in horizontal form. Thus, it is known as horizontal analysis of financial statements. Under this comparison, it can be ascertained as compared to previous year what is increase or decrease in terms of rupees and in terms of percentage during the current year. The development trend of business entity can be seen from this kind of analysis. Example, equity share capital in the year 2016 was rupees 3 lakh and in the year 2017 it is rupees 4,50,000. It means equity share capital is increased by rupees 1,50,000 and in the form of percentage equity share capital is increased by 50% as compared to previous year. 4,50,000 minus 3 lakh divided by 3 lakh into 100. The statements which are prepared in this form are known as comparative statements. 2. Through common size statements, balance sheets and profit and loss statements are considered for this kind of comparative statements also. This analysis is done in the vertical form, thus it is known as vertical analysis of financial statements. Under this comparison, one base is used. For balance sheet, the total of balance sheet is considered as base. For profit and loss statement, sales is considered as base. Example, the total of balance sheet of 2016 is rupees 1 lakh, where non-current assets are of rupees 60,000 and current assets are of rupees 40,000. While in the year 2017, the total of balance sheet is rupees 1,50,000 and where non-current assets are of rupees 75,000 and current assets are of rupees 75,000. Its analysis and interpretation is as follows. Analysis. During 2016, non-current assets are 60%, 60,000 divided by 1 lakh into 100 of total assets and current assets are 40%, 40,000 divided by 1 lakh into 100 of total assets. During 2017, non-current assets are 50%, 75,000 divided by 1,50,000 into 100 of total assets and current assets are also 50%, 75,000 divided by 1,50,000 into 100 of total assets. Interpretation. As compared to the previous year, the proportion of the non-current assets is reduced from 60% to 50%, while the proportion of the current assets is increased from 40% to 50%. Characteristics of comparative and common size financial statements. 1. There is information for 2 or more than 2 years. 2. The comparison of the results of 2 or more than 2 years can be disclosed in the form of rupees. 3. The comparison of the results of 2 or more than 2 years can be disclosed in the form of percentage. 4. This comparison discloses either increase or decrease. 5. The trend of any component of statement can be known through this comparison. Example, the trend of share capital increase or decrease or no change. 6. It can be presented in ratio form. 7. Profit and loss statement and balance sheet of the previous year are compared respectively with the profit and loss statement and balance sheet of the current year. It means the comparison is done. The detailed information of tools of comparison of financial statements is as under. 1. Comparative statements. A. Comparative statement of profit and loss statement. B. Comparative statement of balance sheet. 2. Common size statements. A. Common size statement of profit and loss statement. B. Common size statement of balance sheet. 14. Comparative statements. A. Comparative profit and loss statement. The structure of comparative profit and loss statement is similar comparative balance sheet. There are total 6 columns, but the content of profit and loss statement and balance sheet are different. This analysis is known as the analysis of comparative statements. The comparison of details of 2 years of 2 components of annual accounts profit and loss statement and balance sheet are done. The growth of business entity can be seen through this analysis. Explanation of comparative statement of profit and loss and comparative balance sheet is as under. Structure of comparative profit and loss statement. Comparative profit and loss statements for the year ending on 31st March 2016 and 31st March 2017. Particulars 1. Note number 2. Previous year 3. Current year 4. Increase or decrease 5. In bracket 4 minus 3. Increase or decrease in percentage 6. In bracket 5 divided by 3 into 100. 1. Sales revenue 2. Other income 3. Total revenue 1 plus 2. 4. Expenses 1. Cost of goods consumed 2. Net purchase or resale 3. Change in stock 4. Employees benefit expenses 5. Financial cost 6. Depreciation and amortized expenses 7. Other expenses Total expenses 5. Profit before tax 3 minus 4 6. Less income tax 5 minus 6 7. Profit after tax. There are 2 important components of profit and loss statement. 1. Total revenue and 2. Total expenses. The result of earnings made during the year is available from the profit and loss statement. The increase in revenue indicates the increase in earning and the reduction in expenses also indicates the increase in earning. The reduction in revenue and increase in expenses indicate decrease in earning. What is disclosed by the analysis of profit and loss statement? Profit and loss statement provides information of profitability of business entity. During the current year as compared to previous year, what degree of profitability increase or decrease can be seen from comparative profit and loss statement. In brief, during 2 periods, how much total and total have changed, that is, increase or decrease in terms of rupees and percentage can be ascertained from comparative profit and loss statement. Whether the trend of all components of comparative profit and loss statement is fixed, flexible, decreasing, increasing, can be known through the comparative profit and loss statement. Illustration 1. Prepare comparative profit and loss statements from the following profit and loss statements of Vivekanand Limited for the year ending on 31st March 2016 and 31st March 2017. Summarize profit and loss statements for the year ending on 31st March 2016 and 31st March 2017. Particular Note number 31st March 2017, 31st March 2016. Sales revenue 16 lakh, 14 lakh. Other income 3 lakh, 2 lakh 50,000. Expenses 9 lakh 60,000, 7 lakh 20,000. Answer. Comparative profit and loss statement of Vivekanand Limited for the year ending on 31st March 2016 and 31st March 2017. Particulars 1. Note number 2. 31st March 2016 3. 31st March 2017 4. Increase or decrease 5. In bracket 4 minus 3. Increase or decrease in percentage 6. In bracket 5 divided by 3 into 100. 1. Sales revenue 14 lakh, 16 lakh, 2 lakh, 14.29%. 2. Other income 2 lakh 50,000, 3 lakh 50,000, 20%. 3. Total income 1 plus 2. 16 lakh 50,000, 19 lakh, 2 lakh 50,000, 15.15%. 4. Expenses 7 lakh 20,000, 9 lakh 60,000, 2 lakh 40,000, 33.33%. 5. Profit before income tax 3 minus 4. 9 lakh 30,000, 9 lakh 40,000, 10,000, 1.08%. Illustration 2. The average profit and loss statement ending on 31st March 2016 and 31st March 2017 of Srushti Company Limited are given as follows. Prepare comparative statement of profit and loss. Particulars. Note number 31st March 2017, 31st March 2016. Sales revenue 25,35,000, 19,50,000. Other income 2,85,000, 1,90,000. Cost of goods consumed 11,40,000, 9,50,000. Financial cost 90,000, 1,50,000. Depreciation 60,000, 60,000. Other expenses 4,25,000, 3,40,000. Income tax rate is 30%. Answer. Comparative profit and loss statement of Srushti Company Limited for the year on 31st March 2016 and 31st March 2017. Particulars. 1. Note number 2. 31st March 2016. 3. 31st March 2017. 4. Increase or decrease. 5. In bracket 4 minus 3. Increase or decrease in percentage. 6. In bracket 5 divided by 3 into 100. 1. Sales revenue 19,50,000, 25,35,000, 5,85,000, 30.00%. 2. Other income 1,90,000, 2,85,000, 95,000, 50%. 3. Total income 1 plus 2, 21,40,000, 28,20,000, 6,80,000, 31.78%. 4. Expenses. 1. Cost of good consumed 9,50,000, 11,40,000, 1,90,000, 20%. 2. Financial cost 1,50,000, 90,000, 60,000, 40%. 3. Depreciation 60,000, 60,000. 4. Other expenses 3,40,000, 4,25,000, 85,000, 25%. Total expenses 15 lakh, 17 lakh 15,000, 2 lakh 15,000, 14.33%. 5. Profit before income tax 3 minus 4, 6 lakh 40,000, 11 lakh 5,000, 4 lakh 65,000, 72.66%. 6. Less income tax 30%, 1 lakh 92,000, 3 lakh 31,500, 1 lakh 39,500, 72.66%. 7. Profit after income tax 5 minus 6, 4 lakh 48,000, 7 lakh 73,500, 3 lakh 25,500, 72.66%. Illustration 3. Profit and loss statement for the year ending on 31st March 2016 and 31st March 2017 of Shankar Limited are given as follows. Prepare comparative statement of profit and loss. Particulars. Note number 31st March 2017, 31st March 2016. Sales revenue 60 lakh 75,000, 45 lakh. Other income 7 lakh, 10 lakh. Expenses. Cost of goods consumed 36 lakh, 30 lakh. Net purchase for resale 2 lakh 70,000, 2 lakh. Changes in stock 90,000, 70,000. Employee benefit expenses 5 lakh 60,000, 4 lakh. Financial cost 1 lakh 35,000, 90,000. Depreciation and amortized amount 1 lakh 5,000, 70,000. Income tax rate 30%. Answer. Comparative profit and loss statement of Shankar Limited for the year ending on 31st March 2016 and 31st March 2017. Particulars. 1. Note number 2. 31st March 2016. 3. 31st March 2017. 4. Increase or decrease. 5. In bracket 4 minus 3. Increase or decrease. In percentage 6. In bracket 5 divided by 3 into 100. 1. Sales revenue 45 lakh, 60 lakh 75,000, 15 lakh 75,000, 35%. 2. Other income 10 lakh, 7 lakh, 3 lakh, 30%. 3. Total income 1 plus 2, 55 lakh, 67 lakh 75,000, 12 lakh 75,000, 23.18%. 4. Expenses. 1. Cost of good consumed 30 lakh, 36 lakh, 6 lakh, 20%. 2. Net purchase for resale 2 lakh, 2,70,000, 70,000, 35%. 3. Changes in stock 70,000, 90,000, 20,000, 28.57%. 4. Employee benefit expenses 4 lakh, 5 lakh 60,000, 1 lakh 60,000, 40%. 5. Financial cost 90,000, 1 lakh 35,000, 45,000, 50%. 6. Depreciation and amortized amount 70,000, 1 lakh 5,000, 35,000, 50%. Total expenses 38 lakh 30,000, 47 lakh 60,000, 9 lakh 30,000, 24.28%. 5. Profit before income tax 3 minus 4, 16 lakh 70,000, 20 lakh 15,000, 3 lakh 45,000, 20.66%. 6. Less income tax 30%, 5 lakh 1,000, 6 lakh 4,500, 1 lakh 3,500, 20.66%. 7. Profit after income tax 5 minus 6, 11 lakh 69,000, 14 lakh 10,500, 2 lakh 41,500, 20.66%. Illustration 4. From the following information prepare comparative profit and loss statement. Particular note number 31st March 2017, 31st March 2016. Sales revenue 15 lakh, 9 lakh. Net purchase for resale 9 lakh, 6 lakh. Change in stock 50,000, 50,000. Other expenses percentage of cost of sales 10, 12. Income tax 30%, 30%. Note: changes in stock means difference of opening and closing stock. Changes in stock is equal to opening stock minus closing stock. If difference is positive, will be added to cost of sales or will be deducted from revenue. If difference is negative, will be deducted from cost of sales or will be added to revenue. Relation of opening stock and closing stock with cost of sales and revenue. Cost of sales and revenue are circumstances. Opening stock greater than closing stock, that is positive difference. Opening stock less than closing stock, that is negative difference. Cost of sales will be added, will be deducted. Revenue will be deducted, will be added. Example: purchase rupees 5 lakh and opening stock and closing stock respectively rupees 60,000 and rupees 40,000. In this case, cost of sales will be rupees 5 lakh plus in bracket rupees 60,000 minus rupees 40,000 is equal to rupees 5 lakh 20,000. If opening and closing stock is respectively rupees 40,000 and rupees 60,000. In this case, cost of sales will be rupees 5 lakh in bracket rupees 40,000 minus rupees 60,000 is equal to rupees 4 lakh 80,000. Answer: comparative profit and loss statement for the year ending on 31st March 2016 and 31st March 2017. Particulars: 1. Note number 2. 31st March 2016. 3. 31st March 2017. 4. Increase or decrease. 5. In bracket 4 minus 3. Increase or decrease in percentage. 6. In bracket 5 divided by 3 into 100. 1. Sales revenue 9 lakh, 15 lakh, 6 lakh, 66.67%. 2. Expenses 1. Net purchase for resale 6 lakh, 9 lakh, 3 lakh, 50%. 2. Changes in stock 50,000, 50,000, dash, dash. 3. Other expenses 78,000, 95,000, 17,000, 21.79%. Total expenses 7 lakh 28,000, 10 lakh 45,000, 3 lakh 17,000, 43.54%. 3. Profit before tax 1 lakh 72,000, 4 lakh 55,000, 2 lakh 83,000, 164.53%. 4. Less income tax 30%, 51,600, 1 lakh 36,500, 84,900, 164.53%. 5. Profit after tax 1 lakh 20,400, 3 lakh 18,500, 1 lakh 98,100, 164.53%. Explanation: other expenses is equal to percentage of cost of sales. Therefore, cost of sales is equal to net purchase of resale plus changes in stock. 2016 is equal to 6 lakh plus 50,000 is equal to 6 lakh 50,000 into 12% is equal to rupees 78,000. 2017 is equal to 9 lakh plus 50,000 is equal to 9 lakh 50,000 into 10% is equal to rupees 95,000. Prepare comparative profit and loss statements from the given details. Particular note number 31st March 2017, 31st March 2016. Sales revenue 15 lakh, 18 lakh. Net purchase for resale 6 lakh, 5 lakh. Changes in stock 1 lakh 60,000, 1 lakh. Other expenses percentage of sales 45, 40. Other income percentage of sales 12, 40. Income tax rate 30%, 30%. Answer. Comparative profit and loss statement. Particular 1. Note number 2. 31st March 2016, 3. 31st March 2017, 4. Increase or decrease 5 in bracket 4 minus 3. Increase or decrease in percentage 6 in bracket 5 divided by 3 in 200. 1. Sales revenue 18 lakh, 15 lakh, 3 lakh, 16.67%. 2. Other incomes 1 lakh 80,000, 1 lakh 80,000 dash dash. 3. Total income 1 plus 2 19 lakh 80,000, 16 lakh 80,000, 3 lakh 15.15%. 4. Expenses 1. Net purchase for resale 5 lakh, 6 lakh, 1 lakh 20%. 2. Changes in stock 1 lakh, 1 lakh 60,000, 60,000, 60%. 3. Other expenses 7 lakh 20,000, 6 lakh 75,000, 45,000, 6.25%. Total expenses 13 lakh 20,000, 14 lakh 35,000, 1 lakh 15,000, 8.71%. 5. Profit before tax 6 lakh 60,000, 2 lakh 45,000, 4 lakh 15,000, 62.88%. 6. Less income tax 30%, 1 lakh 98,000, 73,500, 1 lakh 24,500, 62.88%. 7. Profit after tax 4 lakh 62,000, 1 lakh 71,500, 2 lakh 90,500, 62.88%. Explanation. Expenses or years 2016, 2017. 1. Other expenses percentage of sales rupees 18 lakh into 40% is equal to rupees 7 lakh 20,000. Rupees 15 lakh into 45% is equal to rupees 6 lakh 75,000. 2. Other income percentage of sales rupees 18 lakh into 10% is equal to rupees 1 lakh 80,000. Rupees 15 lakh into 12% is equal to rupees 1 lakh 80,000. B. Comparative balance sheet. Format of comparative balance sheet. Balance sheet as on. Particulars 1. Note number 2. Previous year 3. Current year 4. Increase or decrease 5 in bracket 4 minus 3. Increase or decrease in percentage 6 in bracket 5 divided by 3 in 200. Number 1. Equity and liabilities. 1. Shareholders funds. A. Share capital. 1. Equity share capital. 2. Preference share capital. 2. Non-current liabilities. 1. Long-term borrowings. 2. Long-term provisions. 3. Current liabilities. 1. Short-term borrowings. 2. Trade payable. 3. Other current liabilities. 4. Short-term provisions. Total. Number 2. Assets. 1. Non-current assets. A. Fixed assets. 1. Tangible assets. 2. Intangible assets. B. Non-current investments. C. Long-term loan and advances. 2. Current assets. 1. Current investments. 2. Inventories. 3. Trade receivables. 4. Cash and cash equivalent. 5. Short-term loans and advances. 6. Other current assets. Total. Analysis of balance sheet. There are two important components of balance sheet. 1. Equity and liabilities, and 2. assets. Serial number, equity and liabilities, assets. 1. It shows sources of finance. It shows application of finance. 2. It shows that from where finance is created. It shows that where finance is applied. 3. It is known as procurement of funds. It shows investment in assets. 4. Increase in amount shows addition in funds. Increase in amount shows additional investment. 5. Reduction in amount shows refund of funds or reduction in provisions. Reduction in amount shows reduction in non-current assets or current assets. What is disclosed by balance sheet analysis? Balance sheet provides the information about the solvency status of the business enterprise. As compared to the previous long-term and short-term solvency of the business entity, the current solvency is increased or decreased can be known with the help of comparative balance sheet. In brief, during two periods how much? 1. Share capital. 2. Reserves and surplus. 3. Non-current liabilities. 4. Current liabilities as well as 1. Non-current assets. 2. Current assets are changed. That is, increase or decrease in terms of rupee and percentage can be ascertained from comparative balance sheets. Whether the trend of all the components of comparative balance sheet is fixed, flexible, decreasing, increasing, etc. can be known through comparative balance sheet. Illustration 6. Balance sheet of small company limited as at 31st March 2010 and 31st March 2017 are as prepared comparative balance sheet. Particulars. Note number 31st March 2017. 31st March 2016. Number 1. Equity and liabilities. 1. Shareholders funds. A. Share capital. 1. Equity share capital 22 lakh 17 lakh. 2. Preference share capital 10 lakh 12 lakh. B. Reserves and surplus. 1. General reserve 2 lakh 40,000 2 lakh. 2. Profit and loss account 2 lakh 10,000 1 lakh 80,000. 2. Non-current liabilities 10% debentures 6 lakh 8 lakh. 3. Current liabilities. 1. Short-term borrowings 90,000 45,000. 2. Trade payables 90,000 1 lakh 35,000. 3. Other current liabilities 70,000 70,000. Total 45 lakh 43 lakh 30,000. Number 2. Assets. 1. Non-current assets. A. Fixed assets. 1. Tangible assets. Machines 16 lakh 15 lakh. Furniture 6 lakh 5 lakh. 2. Intangible assets. Goodwill 80,000 1 lakh. Patent 7 lakh 50,000 7 lakh 30,000. B. Non-current investments 9 lakh 8 lakh. 2. Current assets. 1. Stock 1 lakh 80,000 1 lakh 60,000. 2. Trade receivables 1 lakh 80,000 2 lakh. 3. Current investments 1 lakh 40,000 2 lakh 70,000. 4. Cash and cash equivalent 70,000 70,000. Total 45 lakh 43 lakh 30,000. Answer. Particulars. 1. Note number 2. 31st March 2016. 3. 31st March 2017. 4. Increase or decrease 5 in bracket 4 minus 3. Increase or decrease in percentage 6 in bracket 5 divided by 3 into 100. Number 1. Equity and liabilities. 1. Shareholders funds. A. Share capital. 1. Equity share capital 17 lakh 22 lakh 5 lakh 29.41%. 2. Preference share capital 12 lakh 10 lakh 2 lakh 16.67%. B. Reserves and surplus. 1. General reserve 2 lakh 2 lakh 40,000 40,000 20.00%. 2. Profit and loss account 1 lakh 80,000 2 lakh 10,000 30,000 16.67%. 2. Non-current liabilities 10% debentures 8 lakh 6 lakh 2 lakh 25.00%. 3. Current liabilities. 1. Short-term borrowings 45,000 90,000 45,000 100%. 2. Trade payables 1,35,000, 90,000, 45,000, 33.33%. 3. Other current liabilities 70,000, 70,000, dash, dash. Total 43,30,000, 45 lakh, 1,70,000, 3.93%. Number 2. Assets. A. Fixed assets. 1. Tangible assets. Machines 15 lakh, 16 lakh, 1 lakh, 6.67%. Furniture 5 lakh, 6 lakh, 1 lakh, 20.00%. 2. Intangible assets. Goodwill 1 lakh, 80,000, 20,000, 20.00%. Patent 7 lakh 30,000, 7 lakh 50,000, 20,000, 2.74%. B. Non-current investments 8 lakh, 9 lakh, 1 lakh, 12.50%. 2. Current assets 1. Stock 1 lakh 60,000, 1 lakh 80,000, 20,000, 12.50%. 2. Trade receivables 2 lakh, 1 lakh 80,000, 20,000, 10.00%. 3. Current investments 2 lakh 70,000, 1 lakh 40,000, 1 lakh 30,000, 48.15%. 4. Cash and cash equivalent 70,000, 70,000, dash, dash. Total 43 lakh 30,000, 45 lakh, 1 lakh 70,000, 3.93%. Illustration 7. Find out balancing figures of comparative statement of Feroz Limited and prepare new comparative statement. Particulars 1. Note number 2. Previous year 3. Current year 4. Increase or decrease 5. In bracket 4 minus 3. Increase or decrease in percentage 6. In bracket 5 divided by 3 into 100. 1. Sales revenue 7,20,000 question mark 35%. 2. Expenses 1. Purchase 4 lakh question mark 100%. 2. Changes in stock 40,000 question mark 200%. 3. Depreciation 40,000 question mark 55%. Total expenses 4,80,000 question mark 71.25%. 3. Profit before tax 2,40,000 question mark 37.5%. 4. Less income tax 30% 72,000 question mark 37.5%. 5. Profit after tax 1,68,000 question mark 37.5%. Answer. Note, the balancing figures are to be ascertained on the basis of amount and change in percentage of previous year. Amount of current year is equal to amount of previous year into in bracket 100 plus change in percentage divided by 100. 1. Sales revenue is equal to 7,20,000 into 100 plus 35 divided by 100 is equal to rupees 9,72,000. 2. Purchase is equal to 4 lakh into 100 plus 100 divided by 100 is equal to rupees 8 lakh. 3. Stock is equal to 40,000 into 100 minus 200 divided by 100 is equal to rupees 40,000. 4. Depreciation is equal to 40,000 into 100 plus 55 divided by 100 is equal to rupees 62,000. 5. Profit before tax is equal to 2,40,000 into 100 plus 37.5 divided by 100 is equal to rupees 1,50,000. 6. Income tax is equal to 72,000 into 100 plus 37.5 divided by 100 is equal to rupees 45,000. 7. Profit after tax is equal to 1,68,000 into 100 plus 37.5 divided by 100 is equal to rupees 1,05,000. Comparative profit and loss statement of Feroz Limited for the year ending on 31st March 2016 and 31st March 2017. Particulars 1. Note number 2. Previous year 3. Current year 4. Increase or decrease 5 in bracket 4 minus 3. increase or decrease in percentage 6 in bracket 5 divided by 3 into 100. 1. Sales revenue 7,20,000, 9,72,000, 2,52,000, 35%. 2. Expenses 1. Purchase 4 lakh, 8 lakh, 4 lakh, 100%. 2. Changes in stock 40,000, 40,000, 80,000, 200. 3. Depreciation 40,000, 62,000, 22,000, 55%. Total expenses 4,80,000, 8,22,000, 3,42,000, 71.25%. 3. Profit before tax 2,40,000, 1,50,000, 90,000, 37.5. 4. Less income tax 30%, 72,000, 45,000, 27,000, 37.5%. 5. Profit after tax 1,68,000, 1,05,000, 63,000, 37.5%. Illustration 8. Find out balancing figures of common size profit and loss statements of 2 years. Particulars, note number, amount, 31st March 2017, 31st March 2016. Percentage to sales, 31st March 2017 in percentage, 31st March 2016 in percentage. 1. Sales revenue, 45 lakh, 60 lakh, 100%, 100%. 2. Expenses, 1. Cost of goods, question mark, 68%, 70%. 2. Financial cost, question mark, 10%, 12%. 3. Depreciation, question mark, 2%, 3%. Total expenses, 36 lakh, 51 lakh, 80%, 85%. 3. Profit before income tax, 9 lakh, 20%, 15%. 4. Less income tax, 30%, question mark, 5. Profit after income tax, question mark. Answer. Necessary calculation. Revenue or expense amount of respective year is equal to total sales revenue of respective year into percentage of revenue or expense or tax of respective year divided by 100. Serial number, particulars, date 31st March 2017, date 31st March 2016. 1. Cost of good, 45 lakh into 68 divided by 100 is equal to rupees 30 lakh 60,000. 60 lakh into 70 divided by 100 is equal to rupees 42 lakh. 2. Financial cost, 45 lakh into 10 divided by 100 is equal to rupees 4 lakh 50,000. 60 lakh into 12 divided by 100 is equal to rupees 7 lakh 20,000. 3. Depreciation, 45 lakh into 2 divided by 100 is equal to rupees 90,000. 60 lakh into 3 divided by 100 is equal to rupees 1 lakh 80,000. 4. Income tax, 9 lakh into 3 divided by 100 is equal to rupees 2 lakh 70,000. 60 lakh into 30 divided by 100 is equal to rupees 2 lakh 70,000. 5. Profit after income tax, rupees 9 lakh minus rupees 2 lakh 70,000 is equal to rupees 6 lakh 30,000. Rupees 9 lakh minus rupees 2 lakh 70,000 is equal to rupees 6 lakh 30,000. Common size profit and loss statement of Dash Limited for the year ending on 31st March 2016 to 31st March 2017. Particulars, note number, amount, 31st March 2017, 31st March 2016. Percentage to sales, 31st March 2017 in percentage, 31st March 2016 in percentage. 1. Sales revenue, 45 lakh, 60 lakh, 100%, 100%. 2. Expenses, 1. Cost of good, 30 lakh 60,000, 42 lakh, 68%, 70%. 2. Financial cost, 4 lakh 50,000, 7 lakh 20,000, 10%, 12%. 3. Depreciation 90,000, 1,80,000, 2%, 3%. Total expenses 36 lakh, 51 lakh, 80%, 85%. 3. Profit before income tax 9 lakh, 9 lakh, 20%, 15%. 4. Less income tax 30%, 2,70,000, 2,70,000, 6%, 4.5%. 5. Profit after income tax 6,30,000, 6,30,000, 14%, 10.5%. Illustration 9. Complete the comparative statement of balance sheets of Reshma Company Limited for the year ending on 31st March 2017. Particulars 1. Note number 2. Previous year 3. Current year 4. Increase or decrease 5. In bracket 4 minus 3. Increase or decrease in percentage 6. In bracket 5 divided by 3 into 100. Number 1. Equity and liabilities. 1. Shareholders funds. A. Share capital. 1. Equity share capital. Question mark. 12 lakh. Question mark. 20%. 2. Preference share capital. Question mark. 10 lakh 50,000. Question mark. 50%. B. Reserve and surplus. Question mark. 5 lakh. Question mark. 66.67%. 2. Non-current liabilities. 10% debentures. Question mark. 4 lakh 50,000. Question mark. 12.5%. 3. Current liabilities. Question mark. 2 lakh. Question mark. 33.33%. Total. Question mark. 34 lakh. Question mark. 33.33%. Number 2. Assets. 1. Non-current assets. A. Fixed assets. 1. Tangible assets. 12 lakh. Question mark. Question mark. 41.67%. 2. Intangible assets. 11 lakh. Question mark. Question mark. 18.18%. 2. Current assets. 2 lakh 50,000. Question mark. Question mark. 60%. Total. 25 lakh 50,000. Question mark. Question mark. 33.33%. Answer. Number 1. Equity and liabilities side. The balancing figures are to be ascertained on the basis of amount and change in percentage of current year. Amount of previous year is equal to amount of current year into 100 divided by 100 plus change in percentage. 1. Equity share capital is equal to 12 lakh into 100 divided by 100 plus 20 is equal to rupees 10 lakh. 2. Preference share capital is equal to 10 lakh 50,000 into 100 divided by 100 plus 50 is equal to rupees 7 lakh. 3. Reserves and surplus is equal to 5 lakh into 100 divided by 100 plus 66.66 is equal to rupees 3 lakh. 4. 10% debentures is equal to 4 lakh 50,000 into 100 divided by 100 plus 12.50 is equal to rupees 4 lakh. 5. Current liabilities is equal to 2 lakh into 100 divided by 100 plus 33.33 is equal to rupees 1 lakh 50,000. Number 2. Asset side. The balancing figures are to be ascertained on the basis of amount of previous year and change in percentage. Amount of current year is equal to amount of previous year into 100 plus change in percentage divided by 100. 1. Tangible assets is equal to 12 lakh into 100 plus 41.66 divided by 100 is equal to rupees 17 lakh. 2. Intangible assets is equal to 11 lakh into 100 plus 18.1818 divided by 100 is equal to rupees 13 lakh. 3. Current assets is equal to 2 lakh 50,000 into 100 plus 60 divided by 100 is equal to rupees 4 lakh. Particulars 1. Note number 2. Previous year 2016 3. Current year 2017 4. Increase or decrease 5. In bracket 4 minus 3. Increase or decrease in percentage 6. In bracket 5 divided by 3 into 100. Number 1. Equity and liabilities. 1. Shareholders funds. A. Share capital. 1. Equity share capital 10 lakh, 12 lakh, 2 lakh, 20%. 2. Preference share capital 7 lakh, 10 lakh 50,000, 3 lakh 50,000, 50%. B. Reserve and surplus 3 lakh, 5 lakh, 2 lakh, 66.67%. 2. Non-current liabilities 10% debentures 4 lakh, 4 lakh 50,000, 50,000, 12.5%. 3. Current liabilities 1 lakh 50,000, 2 lakh 50,000, 33.33%. Total 25 lakh 50,000, 34 lakh, 8 lakh 50,000, 33.33%. Number 2. Assets 1. Non-current assets A. Fixed assets 1. Tangible assets 12 lakh, 17 lakh, 5 lakh, 41.67%. 2. Intangible assets 11 lakh, 13 lakh, 2 lakh, 18.18%. 2. Current assets 2 lakh 50,000, 4 lakh, 1 lakh 50,000, 60%. Total 25 lakh 50,000, 34 lakh, 8 lakh 50,000, 33.33%. Illustration 10. Balance sheets of 2 years of Shyam Limited are as follows. A certain balancing figures. Particulars, note number, amount, 31st March 2016, 31st March 2017. Percentage to total of balance sheet, 31st March 2016, 31st March 2017. Number 1. Equity and liabilities. 1. Shareholders funds. A. Share capital. 1. Equity share capital. Question mark. 20 lakh. 40. Question mark. 2. Preference share capital. Question mark. 10 lakh. 20. Question mark. B. Reserves and surplus. Profit and loss account. Question mark. 8 lakh. 15. Question mark. 2. Non-current liabilities. 10% debentures. Question mark. 10 lakh. 20. Question mark. 3. Current liabilities. 1. Trade payables. Question mark. 1 lakh. 3. Question mark. 2. Other liabilities. Question mark. 1 lakh. 2. Question mark. Total 34 lakh. 50 lakh. 100. 100. Number 2. Assets. 1. Non-current assets. A. Fixed assets. 1. Tangible assets. 10 lakh 20,000. Question mark. Question mark. 35. 2. Intangible assets. 6 lakh 80,000. Question mark. Question mark. 30. B. Non-current investments. 8 lakh 50,000. Question mark. Question mark. 22. 2. Current assets. 1. Trade receivables. 3 lakh 40,000. Question mark. Question mark. 3. 2. Stock. 2 lakh 38,000. Question mark. Question mark. 8. 3. Cash and cash equivalent. 2 lakh 72,000. Question mark. Question mark. 2. Total 34 lakh, 50 lakh, 100, 100. Answer. Necessary calculation. Amount of liabilities side of 2016 year is equal to total of balance sheet of 2016 year into percentage total of balance sheet divided by 100. Serial number, particulars, 2016. Equity and liabilities side. Amount. 1. Equity share capital is equal to 34 lakh into 40 divided by 100 is equal to rupees 13 lakh 60,000. 2. Preference share capital is equal to 34 lakh into 20 divided by 100 is equal to rupees 6 lakh 80,000. 3. Profit and loss account is equal to 34 lakh into 15 divided by 100 is equal to rupees 5 lakh 10,000. 4. 10% debentures is equal to 34 lakh into 20 divided by 100 is equal to rupees 6 lakh 80,000. 5. Trade payables is equal to 34 lakh into 3 divided by 100 is equal to rupees 1 lakh 2,000. 6. Other liabilities is equal to 34 lakh into 2 divided by 100 is equal to rupees 68,000. Amount of liability side of 2017 year is equal to total of balance sheet of 2017 year into percentage of respective assets divided by 100. Serial number, particulars, 2017. Asset side. Amount. 1. Tangible assets is equal to 50 lakh into 35 divided by 100 is equal to rupees 17 lakh 50,000. 2. Intangible assets is equal to 50 lakh into 30 divided by 100 is equal to rupees 15 lakh. 3. Non-current investments is equal to 50 lakh into 22 divided by 100 is equal to rupees 11 lakh. 4. Trade receivables is equal to 50 lakh into 3 divided by 100 is equal to rupees 1 lakh 50,000. 5. Stock is equal to 50 lakh into 8 divided by 100 is equal to rupees 4 lakh. 6. Cash and cash equivalent is equal to 50 lakh into 2 divided by 100 is equal to rupees 1 lakh. Common size balance sheet as on 31st March 2016 and 31st March 2017 of Shyam Limited. Particulars, note number, amount, 31st March 2016, 31st March 2017. Percentage to total of balance sheet, 31st March 2016, 31st March 2017. Number 1. Equity and liabilities. 1. Shareholders funds. A. Share capital. 1. Equity share capital. 13 lakh 60,000, 20 lakh, 40%, 40%. 2. Preference share capital. 6 lakh 80,000, 10 lakh, 20%, 20%. B. Reserves and surplus. Profit and loss account. 5 lakh 10,000, 8 lakh, 15%, 16%. 2. Non-current liabilities. 10% debentures. 6 lakh 80,000, 10 lakh, 20%, 20%. 3. Current liabilities. 1. Trade payables. 1 lakh 2,000, 1 lakh, 3%, 2%. 2. Other liabilities. 68,000, 1 lakh, 2%, 2%. Total 34 lakh, 50 lakh, 100%, 100%. Number 2. Assets. 1. Non-current assets. A. Fixed assets. 1. Tangible assets. 10 lakh 20,000, 17 lakh 50,000, 30%, 35%. 2. Intangible assets. 6 lakh 80,000, 15 lakh, 20%, 30%. B. Non-current investments. 8 lakh 50,000, 11 lakh, 25%, 22%. 2. Current assets. 1. Trade receivables. 3 lakh 40,000, 1 lakh 50,000, 10%, 3%. 2. Stock. 2 lakh 38,000, 4 lakh, 7%, 8%. 3. Cash and cash equivalent. 2 lakh 72,000, 1 lakh, 8%, 2%. Total 34 lakh, 50 lakh, 100%, 100%. 15. Common size statements. The analysis of financial statements can be done through this tool also. Profit and loss statements and balance sheets of 2 years or more than 2 years can be compared with the financial statements of current year with the help of this method. Under this method, the profit and loss statements of the current year are compared with the profit and loss statements of the previous years. This analysis is a vertical analysis. Under this method, one base is used. 100 is considered as the base. Net sales are the base for profit and loss statement. The main objective of every business unit is to earn maximum profit. The enhancement in profit is based on maximum sales and minimum cost. For generation of sales, expenses are incurred. What is the proportion for each expense of sales can be availed from this analysis. Under this method, the statements of 2 years are used. Therefore, it can ascertain whether the proportion of expenses against sales is increased or reduced or remained stable. Necessary actions are taken so that the objective of maximization of profit can be achieved. Sales is equal to 100% is used for the profit and loss statement of every year. Here the percentages of all the items of profit and loss statement with sales are determined. Example, during 2016, the sales is rupees 20 lakhs. The purchase of rupees 8 lakhs and the other expense are of rupees 4 lakhs. So, here the percentage and the other expenses with sales will be 8 divided by 20 into 100 is equal to 40% for purchase. 4 divided by 20 into 100 is equal to 20% for other expenses, 40% and 20% respectively. The percentage against sales will be 6 divided by 18 into 100 is equal to 33 1/3 percentage and 3 divided by 18 into 100 is equal to 16.67 percentage. 33 1/3% and 16.67% respectively for purchase and other expenses. In case of balance sheet as a base, the total of balance sheet is considered. This total is assumed 100%. The total of balance sheet of every year has the base of 100%. Example, the total of the asset side of 2016 is Rs 50 lakhs, where non-current assets are of Rs 35 lakhs and the current assets of Rs 15 lakhs. The percentage respectively are 70% and 30%. 35 divided by 55 into 100 is equal to 70% and 15 divided by 50 into 100 is equal to 30%. If the total of 2017 is of Rs 55 lakhs and non-current assets are of 20 lakhs, their proportion will be 35 divided by 55 into 100 is equal to 63.64% and 20 divided by 55 into 100 is equal to 36.36%, 63.64% and 36.36% respectively. The structure of common size statement. The statement also has 6 columns like comparative statement. In the first column, the information of different components of profit and loss statement and balance sheet are disclosed. The third and the fourth columns disclose the amount of expenses or revenues or liabilities or assets of the previous and the current years. In the fifth and sixth columns of profit and loss statements, the percentage of revenues or expenses of 2 years are calculated and disclosed. In the same manner, in case of balance sheet, the percentage of assets or liabilities of 2 years are calculated and disclosed. The differences between these two percentages of 2 years are used for the analysis and interpretation. The formula to determine percentage. 1. For profit and loss statement, amount of expense or revenue divided by amount of net sales into 100. 2. For balance sheet, amount of liability or assets divided by total of balance sheet into 100. Common size statement of profit and loss statement. All details of profit and loss statements are disclosed as it is. The amounts of 2 years are disclosed. The comparison is feasible if the information of 2 or more than 2 years is available. As stated earlier, the percentage of every revenue and expenses to sales are calculated and disclosed. The specimen of common size statement of profit and loss statement. Common size statement of profit and loss statement for the year ending on dash and dash. Particulars, note number, amount, figures of previous year, figures of current year. Percentage to sales. Percentage of previous year, percentage of current year. 1. Sales revenue. 2. Other income. 3. Total income. 1 plus 2. 4. Expenses. 1. Cost of goods sold. 2. Net purchase for resale. 3. Change in stock. 4. Employees benefit expenses. 5. Financial cost. 6. Depreciation and amortized amount. 7. Other expenses. Total expenses. 5. Profit before tax. 6. Less income tax. 7. Profit after tax. Illustration 11. Prepare common size profit and loss statement from the given profit and loss statement. Particulars, note number, 31st March 2017, 31st March 2016. 1. Sales revenue, 37 lakh 50,000, 30 lakh. 2. Expenses. 1. Purchase for resale, 20 lakh 62,500, 15 lakh. 2. Employees benefit expenses, 2 lakh 50,000, 3 lakh. 3. Financial expenses, 2 lakh 25,000, 1 lakh 80,000. 4. Depreciation and amortized amount, 3 lakh, 2 lakh 70,000. Total expenses, 28 lakh 37,500, 22 lakh 50,000. 3. Profit before tax, 9 lakh 12,500, 7 lakh 50,000. 4. Less income tax 30%, 2 lakh 73,750, 2 lakh 25,000. 5. Profit after tax, 6 lakh 38,750, 5 lakh 25,000. Answer. Common size statements of profit and loss statement for the year ending 31st March 2016 and 31st March 2017. Particulars, note number, amount, 31st March 2016, 31st March 2017. Percentage to sales, 31st March 2016 in percentage, 31st March 2017 in percentage. 1. Sales revenue 30 lakh, 37 lakh 50,000, 100 percentage, 100 percentage. 2. Expenses 1. Net purchase for resale 15 lakh, 20 lakh 62,500, 50 percentage, 55 percentage. 2. Employees benefit expenses 3 lakh, 2 lakh 50,000, 10 percentage, 6.67 percentage. 3. Financial cost 1 lakh 80,000, 2 lakh 25,000, 6 percentage, 6 percentage. 4. Depreciation and amortized amount 2 lakh 70,000, 3 lakh, 9 percentage, 8 percentage. Total expenses 22 lakh 50,000, 28 lakh 37,500, 75 percentage, 75.67 percentage. 3. Profit before tax 7 lakh 50,000, 9 lakh 12,500, 25 percentage, 24.33 percentage. 4. Less income tax 30%, 2 lakh 25,000, 2 lakh 73,750, 7.5 percentage, 7.30 percentage. 5. Profit after tax 5 lakh 25,000, 6 lakh 38,750, 17.5 percentage, 17.03 percentage. Explanation. 1. Purchase for resale. This expense is increased by 5% as compared to the previous year. This increases in the expense affect the profit and the profit gets decreased. Necessary steps are taken to erase the increase in the expense. 2. The percentage in employee benefit expense. Depreciation and amount amortizes are reduced. Due to the reduction in the expense, the profit is increased. No change in the percentage of the financial cost. 3. There is a significant increase in the total expenses by 0.67 percentage. 4. Since the proportion of expenses is increased, the profit is reduced. Consequently, the percentage of tax also is reduced from 7.5% to 7.30%. 5. Finally, the percentage of profit after tax is reduced due to the increase in the proportion of expense. The profit after tax is reduced from 17.5% to 17.03%. Common size statement of balance sheet. Its structure is as follows. All the details of balance sheet are disclosed as it is. The amount of 2 years is disclosed. The comparison is possible only if the details of 2 or more than 2 years are available. The total of balance sheet is considered as the base. The liabilities and assets of respective years are disclosed in their proportion to total of balance sheet. Here, the proportions are determined in vertical form. Format of common size statement of balance sheet. Common size statement of balance sheet as on dash and dash. Particulars, note number, amount, figures of previous year, figures of current year. Percentage to sale. Percentage of previous year, percentage of current year. Number 1. Equity and liabilities. 1. Shareholders funds. A. Share capital. 1. Equity share capital. 2. Preference share capital. B. Reserve and surplus. 2. Non-current liabilities. 1. Long-term borrowings. 2. Long-term provisions. 3. Current liabilities. 1. Short-term payables. 2. Trade payables. 3. Other current liabilities. 4. Short-term provisions. Total. Number 2. Assets. 1. Non-current assets. A. Fixed assets. 1. Tangible assets. 2. Intangible assets. B. Non-current investments. C. Long-term loan and advance. 2. Current assets. 1. Current assets. 2. Stock. 3. Trade receivable. 4. Cash and cash equivalent. 5. Short-term loan and advances. 6. Other current assets. Total. Illustration 12. From the following given abridged balance sheet as on 31st March 2016 and 31st March 2017. Prepare common size statement of balance sheet. Balance sheet as on 31st March 2016 and 31st March 2017. Particulars, note number, 31st March 2017, 31st March 2016. Number 1. Equity and liabilities. 1. Shareholders funds. A. Share capital 8 lakh, 12 lakh. B. Reserve and surplus 4 lakh, 3 lakh. 2. Non-current liabilities. Long-term borrowings 6 lakh, 4 lakh. 3. Current liabilities. Trade payables 2 lakh, 1 lakh. Total 20 lakh, 20 lakh. Number 2. Assets 1. Non-current assets. Fixed assets, tangible assets 16 lakh, 18 lakh. 2. Current assets 1. Stock 2 lakh 50,000, 1 lakh 25,000. 2. Cash and cash equivalent 1 lakh 50,000, 75,000. Total 20 lakh, 20 lakh. Answer. Common size statements of balance sheet as on 31st March 2016 and 31st March 2017. Particulars. Note number. Amount. 31st March 2016, 31st March 2017. Percentage to balance sheet. 31st March 2016, 31st March 2017. Number 1. Equity and liabilities. 1. Shareholders funds. A. Share capital 12 lakh, 8 lakh, 60%, 40%. B. Reserve and surplus 3 lakh, 4 lakh, 15%, 20%. 2. Non-current liabilities. Long-term borrowings 4 lakh, 6 lakh, 20%, 30%. 3. Current liabilities. Trade payables 1 lakh, 2 lakh, 0.5%, 10%. Total 20 lakh, 20 lakh, 100%, 100%. Number 2. Assets 1. Non-current assets. Fixed assets, tangible assets 18 lakh, 16 lakh, 90%, 80%. 2. Current assets 1. Stock 1 lakh 25,000, 2 lakh 50,000, 6.25%, 12.50%. 2. Cash and cash equivalent 75,000, 1 lakh 50,000, 3.75%, 7.50%. Total 20 lakh, 20 lakh, 100%, 100%. Explanation. 1. Total of balance sheet of both years is identical. 2. As compared to the previous year, the proportion of share capital is reduced from 60% to 40%. 3. As compared to the previous year, the reserve and surplus, the long-term borrowings, and the current liabilities are increased. 4. The proportion of the non-current assets is reduced, but the proportion of current assets is increased. Illustration 13. Common size profit and loss statement of Shri Ram Limited, year ending on 31st March 2016 and 31st March 2017 is given below. Particulars. Note number. Amount. 31st March 2016, 31st March 2017. Percentage to sales. 31st March 2016, 31st March 2017. Number 1. Sales revenue. 25 lakh, 30 lakh, 100%, 100%. Number 2. Expenses. 1. Cost of goods consumed. Question mark, 75%, 78%. 2. Financial expenses. Question mark, 9.6%, 8%. Number 3. Depreciation. Question mark, 3%, 4%. Total expenses. 21 lakh 90,000, 27 lakh, 87.6%, 90%. 3. Profit before tax. 3 lakh 10,000, 3 lakh, 12.4%, 10%. 2. Less income tax 30%. Question mark, 90,000, 3.72%, 3%. 5. Profit after tax. Question mark, 2 lakh 10,000, 8.69%, 7%. Answer. Explanation. The sale in the best of all the revenues and expenses for the common size profit and loss statement. The proportion of the other income and expenses to sales is ascertained. Its formula is as follows. Proportion of revenue or expense to sales is equal to amount of revenue or expenses in rupees divided by amount of sales in rupees into 100. Here, in place of the amount of expenses, their percentages to sales are given. This will be calculated as follows. Revenue or expense amount in rupees is equal to net sales into percentage of revenue or expense or tax divided by 100. Number. Particulars 2016-2017. 1. Cost of goods consumed. 25 lakh into 75 divided by 100 is equal to rupees 18 lakh 75,000. 30 lakh into 78 divided by 100 is equal to rupees 23 lakh 40,000. 2. Financial cost 25 lakh into 9.6 divided by 100 is equal to rupees 2 lakh 40,000. 30 lakh into 8 divided by 100 is equal to rupees 2 lakh 40,000. 3. Depreciation 25 lakh into 3 divided by 100 is equal to rupees 75,000. 30 lakh into 4 divided by 100 is equal to rupees 1 lakh 20,000. 4. Income tax 25 lakh into 3.72 divided by 100 is equal to rupees 93,000. Dash. 5. Profit after tax 25 lakh into 8.67 divided by 100 is equal to rupees 2 lakh 17,000. Common size profit and loss statement of Shri Ram Limited year ending on 31st March 2016 and 31st March 2017. Particulars, note number, amount, 31st March 2016, 31st March 2017. Percentage to sales, 31st March 2016 in percentage, 31st March 2017 in percentage. 1. Sales revenue, 25 lakh, 30 lakh, 100%, 100%. 2. Expenses, 1. Cost of goods consumed, 18 lakh 75,000, 23 lakh 40,000, 75%, 78%. 2. Financial expenses, 2 lakh 40,000, 2 lakh 40,000, 9.6%, 8%. 3. Depreciation, 75,000, 1 lakh 20,000, 3%, 4%. Total expenses, 21 lakh 90,000, 27 lakh, 87.6%, 90%. 3. Profit before tax, 3 lakh 10,000, 3 lakh, 12.4%, 10%. 4. Less income tax 30%, 93,000, 90,000, 3.72%, 3%. 5. Profit after tax 2 lakh 17,000, 2 lakh 10,000, 8.69%, 7%. Illustration 14. Balance sheets of 2 years of Saurashtra Limited are as follows. Prepare common size statement. Particulars, note number, 31st March 2017, 31st March 2016. Number 1. Equity and liabilities. 1. Shareholders' funds. A. Share capital. 1. Equity share capital, 25 lakh, 25 lakh. 2. Preference share capital, 15 lakh. B. Reserves and surplus. 1. General reserve, 8 lakh, 6 lakh. 2. Profit and loss account, 4 lakh 50,000, 6 lakh. 2. Non-current liabilities, 9% bank loan, 15%, 15%. 3. Current liabilities, 1. Short-term borrowings, 6 lakh, 2 lakh. 2. Other current liabilities, 1 lakh 50,000, 6 lakh. Total, 75 lakh, 60 lakh. Number 2. Assets. 1. Non-current assets. A. Fixed assets. 1. Tangible assets. Machines, 15 lakh, 20 lakh. Land buildings, 25 lakh, 15 lakh. 2. Intangible assets. Trademark, 5 lakh, 3 lakh 40,000. Goodwill, 4 lakh 50,000. Dash. B. Non-current investments, 15 lakh, 15 lakh. 2. Current assets. 1. Debtors, 3 lakh 75,000, 3 lakh. 2. Stock, 3 lakh 75,000, 2 lakh 40,000. 2. Cash and cash equivalent, 3 lakh, 1 lakh 20,000. Total, 75 lakh, 60 lakh. Answer. Common size balance sheet as on 31st March 2016 and 31st March 2017 of Saurashtra Limited. Particulars, note number, amount, 31st March 2016, 31st March 2017. Percentage to sales, 31st March 2016, 31st March 2017. Number 1. Equity and liabilities. 1. Shareholders' funds. A. Share capital. 1. Equity share capital, 25 lakh, 25 lakh, 41.67%, 33.33%. 2. Preference share capital, dash, 15 lakh, dash, 20%. B. Reserves and surplus. 1. General reserve, 6 lakh, 8 lakh, 10%, 10.67%. 2. Profit and loss account, 6 lakh, 4 lakh 50,000, 10%, 6%. 2. Non-current liabilities, 9% bank loan, 15 lakh, 15 lakh, 25%, 20%. 3. Current liabilities, 1. Short-term borrowings 2 lakh, 6 lakh, 3.33%, 8%. 2. Other current liabilities 6 lakh, 1 lakh 50,000, 10%, 2%. Total 60 lakh, 75 lakh, 100%, 100%. Number 2. Assets 1. Non-current assets. A. Fixed assets 1. Tangible assets. Machines 20 lakh, 15 lakh, 33.33%, 20%. Land building 15 lakh, 25 lakh, 25%, 33.33%. 2. Intangible assets. Trademark 3 lakh 40,000, 5 lakh, 5.67%, 6.67%. Goodwill dash 4 lakh 50,000 dash 6%. B. Non-current investments 15 lakh, 15 lakh, 25%, 20%. Number 2. Current assets 1. Debtors 3 lakh, 3 lakh 75,000, 5%, 5%. 2. Stock 2 lakh 40,000, 3 lakh 75,000, 4%, 5%. 3. Cash and cash equivalent 1 lakh 20,000, 3 lakh, 2%, 4%. Total 60 lakh, 75 lakh, 100%, 100%. Illustration 15. Find out balancing figures of common size balance sheet as at 31st March 2016 and 31st March 2017 of Dahod Limited. Particulars: note number, amount, 31st March 2016, 31st March 2017. Percentage to balance sheet, 31st March 2016, 31st March 2017. Number 1. Equity and liabilities. 1. Shareholders' funds. A. Share capital. 1. Equity share capital. Question mark 14,52,000, 20%, 22%. 2. Preference share capital. Question mark 7,26,000, 10%, 11%. B. Reserve and surplus. 1. General reserve. Question mark 3,63,000, 10%, 5.5%. 2. Profit and loss account. Question mark 14,52,000, 20%, 22%. 2. Non-current liabilities. 1. 15% debentures. Question mark 7,26,000, 10%, 11%. 2. Loan of BOB. Question mark 7,26,000, 10%, 11%. 3. Current liabilities. 1. Short-term borrowings. Question mark 3,63,000, 8%, 5.5%. 2. Other current liabilities. Question mark 3,63,000, 7%, 5.5%. 3. Short-term provisions. Question mark 4,29,000, 5%, 6.5%. Total 50 lakh, 66 lakh, 100%, 100%. Number 2. Assets. 1. Non-current assets. A. Fixed assets. 1. Tangible assets. Land 15 lakh, 19 lakh 80,000, 30%. Question mark. Plant machinery 5 lakh, 6 lakh 60,000, 10%. Question mark. Building 7 lakh 50,000, 11 lakh 88,000, 15%. Question mark. B. Non-current investment 10 lakh, 7 lakh 92,000, 20%. Question mark. 2. Current assets. 1. Current investments 5 lakh, 9 lakh 90,000, 10%. Question mark. 2. Stock 5 lakh, 6 lakh 60,000, 10%. Question mark. 3. Cash and cash equivalent 2 lakh 50,000, 3 lakh 30,000, 5%. Question mark. Total 50 lakh, 66 lakh, 100%, 100%. Explanation. This illustration is mixed in nature. 1. Amount and liability side is to be found out from percentage for 2016. For this, the following formula will be used. Amount in rupees for equity and liability side of year 2016 is equal to total of balance sheet of 2016 into percentage of respective liability divided by 100. 2. Percentage of asset sides is to be found out from amount for 2017. For this, the following formula will be used. Percentage of assets with the total of the balance sheet is equal to amount of respective asset divided by total of balance sheet into 100. Necessary calculation. Number, particulars, 2016 equity liability side. Number, particulars, 2017 asset sides in percentage. 1. Equity share capital, 50 lakh into 20 divided by 100 is equal to rupees 10 lakh. 1. Land, 19 lakh 80,000 divided by 66 lakh into 100 is equal to 30%. 2. Preference share capital, 50 lakh into 10 divided by 100 is equal to rupees 5 lakh. 2. Plant and machinery, 6 lakh 60,000 divided by 66 lakh into 100 is equal to 10%. 3. General reserve, 50 lakh into 10 divided by 100 is equal to rupees 5 lakh. 3. Building, 11 lakh 88,000 divided by 66 lakh into 100 is equal to 18%. 4. Profit and loss account, 50 lakh into 20 divided by 100 is equal to rupees 10 lakh. 4. Non-current investments, 7 lakh 92,000 divided by 66 lakh into 100 is equal to 12%. 5. 15% debentures, 50 lakh into 10 divided by 100 is equal to rupees 5 lakh. 5. Current investments, 9 lakh 90,000 divided by 66 lakh into 100 is equal to 15%. 6. Loan of BOB, 50 lakh into 10 divided by 100 is equal to rupees 5 lakh. 6. Stock, 6 lakh 60,000 divided by 66 lakh into 100 is equal to 10%. 7. Short-term borrowings, 50 lakh into 8 divided by 100 is equal to rupees 4 lakh. 7. Cash and cash equivalent, 3 lakh 30,000 divided by 66 lakh into 100 is equal to 15%. 8. Other current liabilities, 50 lakh into 7 divided by 100 is equal to rupees 3 lakh 50,000. 9. Long-term provisions, 50 lakh into 5 divided by 100 is equal to rupees 2 lakh 50,000.